Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us here at Ausbiz as we look at what happened overnight. We are expecting a positive session. Now, this follows a positive session on global markets, while the threat of US tariffs sent gold to a new record high. Now, stocks on Wall Street rose as investors reacted to the latest earnings results. Apple reported after the bell and beat expectations for quarterly profit, their overall revenue rising 4% in the first quarter. However, the company reported weak iPhone sales due to Chinese competition and AI rollout issues. Earlier, Microsoft fell after forecasting disappointing growth in its cloud computing business, while Meta rose after beating fourth quarter revenue estimates. And in fact, the CEOs of both Meta and Microsoft defended their heavy capex on AI. It's days after Chinese startup DeepSeek unveiled a breakthrough in cheap AI models that rattled investors. Elsewhere, Tesla shares rose after saying it was on track to roll out new, cheaper EV models in the first half of 25. It also said it would start testing a paid autonomous car service in June, overshadowing quarterly results that fell short of expectations. UPS shares plummeted after forecasting 2025 revenue below expectations. And MasterCard reported a fourth quarter profit beat as consumers ramped up spending during the holiday season, while after the bell, Visa reported a higher first quarter profit. Well, the European Central Bank has cut rates by 25 basis points and opened the way for further easing on signs of economic weakness. It was the fifth ECB rate cut since last June, taking it to 2.75%, with markets expecting 2 or 3 more cuts this year. ECB President Christine Lagarde saying the disinflation process is well on track. We know the direction of travel, she said, at which pace, with what sequence, what magnitude, will be informed by the data that we collect in the coming weeks and months. Well, US economic growth slowed in the fourth quarter as a strike at Boeing depressed business investment in equipment, but consumer spending increased at its fastest pace in nearly 2 years. GDP increasing at a 2.3% annualised rate last quarter. That's slower than the 3.1% pace seen in the September quarter. US Treasury yields initially fell, but then recovered after data showed that the number of Americans filing jobless claims fell more than expected last week. The yield on the 2-year note was lower at 4.2%, the 10-year down around 4.5 basis points at 4.51. And the US dollar dipped against major currencies. The markets factored in slower than expected US economic growth and that rate cut by the ECB. However, the Aussie has fallen to 62.1 US cents. And Bitcoin is at around 105,000 US dollars. Commodities broadly higher. Brent crude rising to around $77 a barrel, though prices were kept in check by threatened US tariffs on Canadian and Mexican crude that could take effect this weekend. Copper was up almost 1%. Iron ore little changed at 106 US dollars a tonne. And the gold price hit a record sparked by safe haven demand on threats of US tariffs. Spot gold up around 1.3%, climbing to just shy of $2,800 an ounce. Well, let's get some reaction as to that move by the ECB, which was expected, but of course more rates forecast. I caught up earlier with Fiona Cincotta from City Index.
As expected, the ECB cut rates by 25 basis points. A move that's been widely telegraphed by policymakers at Davos and even prior. But I think what's the problem here with the Eurozone is actually concerns about the economic outlook. It's not necessarily an inflation problem, it's a growth problem. The economy is stalling. We've seen that in Q4, the economy stalls in Germany, the largest economy in the Eurozone, actually contracted. There's also weakness in France, another very large economy within the Eurozone. So whilst inflation has actually just ticked that little bit higher at around 2.4%, so it's just a little bit above the 2% target, growth is flatlined. There's concerns, I think, of it actually potentially going into a contraction. As I said, sort of Germany, their economy did contract. So the ECB is looking to actually support the growth side of things. I think they are comfortable that inflation is cooling towards that 2% target anyway. And we know from the December meeting, the minutes, that the ECB was quite comfortable that inflation was going to cool by middle of this year to the 2% target. And I think we very much got the feeling that that's still the case. But there are concerns about growth. And I think then when we throw in sort of the uncertainty with regards to Trump and potential trade tariffs, that just adds to those concerns over the growth outlook for the region.
Yeah, just there is obviously that threat from the Trump administration in terms of tariffs. It appears to be somewhat of a reprieve, though, certainly as far as the Eurozone is concerned. What was the feeling? What do we hear from Christine Lagarde in terms of the prospect of US tariffs?
Yeah, so I think, the big question is whether it's going to be inflationary or deflationary if it happens. I mean, obviously, we feel there is a sense that Trump hasn't been as aggressive as far as trade tariffs are concerned as was initially feared, but that doesn't mean that they're not coming. So, but until there are concrete policies in place from Trump, it's very difficult for the ECB, Christine Lagarde, or any other country for that matter, to really sort of try and address policy in order to plan for such policies. So she said that she was unsure what effect it would have on the economy, as I said, whether it would be inflationary or deflationary. But what she has said that is that it will be a negative effect. So I think that's what we're looking at, is sort of if these tariffs are implemented. I think the biggest concern for the Eurozone would be actually if it caused a massive slowdown in growth, given the weak growth picture that there is already.
So, Fiona, ECB policymakers flagging more rate cuts to come, possibly as early as March. What that would take it to around 2.5%. Where's the neutral rate as far as the ECB is concerned?
Yeah, so I think they're still restrictive at the moment. I think sort of we could even look down to a move towards the 2% level, or even the 1.5 right now. I mean, it just depends really on what's going to happen. We know that if we do get another rate cut in March, that does then give the ECB the opportunity to assess what's going on as far as policies from the US are concerned, because by then we'll probably have a good idea of what might be happening. But yeah, so I think there are several more rate cuts expected this year, 2 or 3 at least, and as you said, one in March and potentially a couple more throughout the year. So, and I think that has had an impact on the euro as well. We've seen the euro has been under pressure. It's trading below that 104 mark. I mean, it has picked up off the low that we saw below 102 at the very start of the year, but it's still weak around that 104 level. And I think the outlook for the euro does remain pretty downbeat for the time being as well, given the divergence that we're seeing in not only the ECB and the Fed, but also the growth outlook for the Eurozone and the US.
And Fiona, how would you assess the performance of European equities?
Well, they've been a bright spot, actually. I mean, if we look at the DAX is trading at all-time highs, which is really interesting. It's obviously getting this boost from optimism of and expectations of lower interest rates from the ECB, which has really given the DAX a boost. It's, even on Monday when, we saw that sort of global rout in tech stocks, and quite a few indices across the globe really suffered. The DAX held up pretty well compared to some of its peers. So Euro stocks as well holding up. So I think, broadly speaking, stocks in Europe are being supported by expectations of lower interest rates. And that seems to be really boosting the mood and the demand for stocks more than those growth concerns. But also because I think there is a little bit more of a sense of optimism surrounding China as well for the time being. And that's also sort of helping European stocks, helping the automakers in the DAX as well. And not quite in the European Union still, but it's helped the FTSE as well get to record highs.
Meanwhile, across the channel, looks as though the Bank of England is poised to cut again. Mind you, rates are certainly much higher there than in Europe.
Yes, that's right. We've had a real problem as far as sticky inflation's concerned, particularly service sector inflation, which has really struggled to fall until just recently we started to see some inroads in that cooling. But wage growth does remain pretty elevated as well. So it does look like the Bank of England is going to be cutting interest rates by 25 basis points again in February. But actually, I think the outlook is starting to turn quite a bit weaker as far as inflation is concerned, especially when we think about sort of what reaction that we're starting to see from companies to the budget that was announced in April, which obviously increased the tax burden on many companies as far as national insurance is concerned. So what we've seen now is there is a sense that hiring is coming under pressure. Firms are slowing hiring, cutting hiring, and even cutting staff. So we're starting to see, I think we're going to be starting to see more impact in the labour market of those decisions that the Chancellor took in October. And I think that does mean that we're going to start to see wage growth reduce. We're going to see unemployment tick higher, that weakness in the labour market then feed through to the economy and lower inflation. So I do think the outlook now for rate cuts is actually probably picking up than what it has been previously as a result of the budget. So that could mean that when we hear from the Bank of England next week, that we do hear that they will be considering more rate cuts to come across this year.
And Fiona, how's the FTSE tracking at the moment?
Yeah, so I mean, the FTSE is doing very well. We're at all-time highs, which is some great news because the FTSE was trading in a very familiar range for much of the second part of, or since April last year. It's been range bound, really between that sort of 83.25 and 81.50. Now we've broken out. We've had a great start to the new year, basically thanks in part to the weaker pound, which has helped those multinationals on the FTSE. We've seen strength in the banking sector as well. And as I said, we've seen some strength in the heavyweight miners, which has really helped the FTSE get to record highs. I think it was up at 86, over 86.10, record high earlier today.
Fiona Cincotta from City Index out of London. Let's come back home. Check where we're likely to get going. Looking for a positive start, up more than 0.4%. That would take us, if that transpired, to another record high on the ASX 200. Stay with us because the open is just a couple of minutes away.